We're going to talk about Michaels today, and I think the context we're going to talk about them is this is one of those companies that if you look at the numbers, it really looks like it could be a value stock. However, we're going to walk through some concerns that could make it a value trap. But before we dive into that, let's just give some brief history of the company and kind of where it's come from in the past recent years. Can you kind of walk us through Michaels' history as a public company and where it sits today?
Sure. So Michaels was founded in 1974 by a businessman named Michael Dupy in Dallas, Texas. This company began trading on the NASDAQ actually in 1984 as the Michaels Companies, but it was taken private by private equity firms Bain Capital and Blackstone Group. Those are two pretty familiar names if you are familiar at all with the private equity world. That was in 2006 for a price tag of $6 billion. The company was reintroduced to the public markets in June of 2014. They raised $472 million in that offering. Most of the proceeds were allocated to pay down the company's oversized debt load. At that time, it was $3.7 billion, and debt load is going to be a recurring theme today. Bain still owns 34% of the outstanding stock in this company. Blackstone still has a 13% stake. I want to note before we move forward, in this second go round in the public markets, what has their stock performance look like, up or down? Now, listeners, I'll take a millisecond for you to guess. The answer is shares are down about 42% cumulatively, but we will get into the whys of that in just a moment.
Yeah, that's why folks might be viewing this company as a value stock. And just for a little bit more context, Michaels is the largest crafts and specialty retailer in North America based on store count, has 1,262 stores in the U.S. and Canada. They define their market when we talked about whether we craft. Over 53% of U.S. households participated in at least one crafting project during 2018. So really a robust market there. But so when you look at some of the numbers here on this company, it really can pop out on some traditional value metrics. So if you look at their forward priced earnings, it's about 4. Their gross margin is higher than what you would expect from the typical store-based retailer. But the big number that really popped out to me and why I wanted to talk about this company today is looking at their free cash flow. So if you look at their free cash flow from last year, they had about $300 million in free cash flow. And so if you take that number and divide it by their market cap, which currently is $1.5 billion, that gives you a free cash flow yield of about 20%, which is extremely strong relative to the broader market. And when you look at investing in a company, you can generally get a decent picture of what you can expect your returns to be over time by looking at that free cash flow yield and then adding in what your expected growth in free cash flow is over time. As we've talked about with Michaels, it's in a market that's probably mature, and so you can't expect free cash flow to grow in a really significant way over time. But the question of whether this stock is a value will be whether they can keep the market clearly at the position that it's valued today is expecting that free cash flow yield to decline over time. But however, if we can identify some trends that will say that will be stable over time, there's a real chance that this stock is overvalued. So Asid, you've had a chance to look through some of these free cash flow numbers and those types of stats coming out of Michaels. What has popped out to you about this company when you just take a high level look?
I love the margins, gross margin of 35%. Free cash flow, again, as you stated, that pops out at me. And for listeners, for those of you who are unfamiliar with this term, free cash flow is operating cash flow, so the cash the company generates from its operations, minus the physical assets that it buys during the year or any small acquisitions. So you subtract basically equipment, fixed asset purchases from this operating cash, you get free cash flow. And after that, whatever money is left over to pay your debt service, to maybe pay investors in the form of a dividend or reinvest further in the business, that's all gravy. So the company has this high free cash flow yield that popped out at me as well. I like the stability of the sales given this really bad retail environment. Comparable sales this year in fiscal 2019 are expected to be flat versus the prior year. That means that average store in the company's store base isn't really going to increase sales at all. But compared to many physical store-based retailers, listeners, you just heard the news probably a couple of days ago, Forever 21 is the latest retailer to declare bankruptcy. I'll take flat comps. I don't think that's such a bad number. It shows that at least the sales are stable and can be improved. So that also jumps out at me. Net margins, they average in the low to mid single digits, and that again is pretty decent for a retailer in this day and age. Now, some of the stuff that's not so appealing is that debt on the balance sheet. Before we talk about the debt, though, I do want to point out, if we looked at the asset side of this company, if it's a stable company with very stable operating cash flows, you'd expect over time, if they're rising even slightly, that is the cash flows, the company would be building up a big cash balance. But like many retailers, Michaels has most of its assets in its inventory. So it's got these 1,200 odd stores that Nick told you about. It constantly has to buy inventory. So it has this balance between payables to its vendors, cash that it needs to pay down its accounts payable, and this big inventory balance. So the inventory as of the last quarter was $1.25 billion. I'll return to that number in just a bit during this segment. Now, debt. Debt's at $2.7 billion. And Nick, you and I were crunching what this means, and we talked earlier today. Versus its equity, you really can't get a read because Michaels has negative equity. It's got a shareholder's deficit, and this is from losses that it sustained years and years ago. So over the course of decades, it's actually built a shareholder's deficit. So for those of you listeners who like to hear, well, what's the debt to equity, we really can't give you that number. We can say that the company is able to cover its interest obligations. Its times interest earned ratio is roughly 4. That means that net earnings cover the interest burden about 4 times over during a year. That's sort of thin, but on the other hand, I've seen worse. Final note about the debt. If you look at a very widely used metric, which is debt to EBITDA, that is debt to earnings before interest, taxes, depreciation, and amortization, that ratio sits at around 3.5 times. It's another number that we crunched just before taping today. And that's actually moderate leverage, although relative to its own balance sheet, it's got a big debt load that needs to be addressed. If you look at what this means in the big picture, the leverage is moderate, it's acceptable, it's a problem that can be solved. One of the questions that we'll toss back and forth is, does the company want to solve this debt problem? What jumped out at you, Nick, about the balance sheet?
Yeah, so taking a look at the balance sheet, as you said, that high leverage number obviously pops out to me. You expect to see that from a company that has been brought public in recent years by private equity. But to the extent that we should be concerned about the debt, it kind of comes back to that free cash flow number that we talked about before, is whether that at the current amount of cash that the company is turning out, we shouldn't be too concerned about their ability to at least sustain their interest payments on the debt and that sort of thing. But where it does become a concern is if we see the business continue to deteriorate over time and we see that cash flow begin to drop.